Hello everyone, welcome to the Ashworth Wealth Weekly Market Update. I'm going to be covering a couple of quick things today. For those of you who don't know me, I'm Todd McChesney. This week we're going to talk about gold. Just want to spend a couple minutes talking about this. This chart kind of just shows the historical performance from 1988 to 2024, January of 88 to March of 24, just last month. It shows the annualized total return versus the volatility. You can see the S&P 500 has averaged about 11%. The MSCI World Index has averaged about 8.2%, whereas gold is at about 4.5%. But what's interesting is not only is gold underperforming those other two asset classes, look at the volatility. Gold is the most volatile along with the world markets of those three that we're comparing there. And so as you look at that, a lot of times we get really excited about gold. Last week gold prices broke above 2,300 per ounce for the first time ever. There's a lot of reasons for that. Most of that comes down to interest rates. People are hoping for a soft landing, but they're concerned if it doesn't happen. The Fed has kind of announced, well, we may not cut rates as fast as we thought we might do that, and so gold is kind of going up. A lot of people are excited about investing in gold just because there's some global conflicts going on. A lot of people consider it to be a safe haven investment, but as a general rule, gold is not a great long-term investment over the last 46 years. I go back to one of the world's greatest investors that I've known, and that's Warren Buffett. I was at a meeting of his, and I mentioned this to a lot of people. I probably think this meeting was 8 or 10 years ago. It was probably 15 or 18 years ago. Somebody asked him a question one day at the Berkshire Hathaway shareholder meeting. They said, "Do you think we should be buying gold in our portfolios? Should people hold it, gold?" And his response was just amazing. And he said, "I think investing in gold is a great hedge against making money." Effectively, he's saying exactly what this chart is saying. Gold doesn't pay a dividend. Gold isn't based on earnings. Gold is just there to provide a hedge. It's there for a hedge. When interest rates get really, really out of control and inflation takes off, gold is going to generally grow at the rate of inflation. It's done that for a few thousand years. So there's obviously utility reasons for having gold, but for the most part, gold is just not a good long-term investment for a portfolio. Doesn't mean you shouldn't have any gold, but it's not something that you would expect to grow over time at the rate that other asset classes do. I find it also interesting that as people get excited about gold, we joke all the time that gold is one of those investments that you purchase late night on cable television. Radio shows, they advertise gold. Cable TV shows advertise gold. But there's usually high commissions on those, and you buy it, you have to pay a commission to buy it, you have to pay a commission to sell it. It's just not a good long-term investment. That's pretty much it this week. Just be aware that as we look at these ideas, and sometimes they make sense, sometimes they don't. The most important thing to be doing is to have a globally diversified portfolio and to hedge all of your risks. Once again, does it mean we shouldn't have any gold? No, but I think for the most investors probably shouldn't own any gold. Maybe the fund that you have has a little bit of access to gold or other precious metals, but for the most part, it's not something that we want to get too excited about and own on a regular basis. Feel free to forward this email to anyone that you would like to do so. And if you have any questions, please reach out to the office. We're more than happy to chat anytime, and we'll look forward to seeing you next time. Thanks. Bye-bye.